let's move on now to Octavio's question, I believe. Yes, indeed. Octavio says, Mike, will you consider the use of a collar for the purpose of freezing gains for a period of a few months to avoid paying cap gains? Other reasons, what type of collar will work? Thank you. Will you do a married put or a collar, Octavio? So let's say I have a stock that has an unrealized gain in it. Let me just go to the portfolio here and check my original price on KHC. And that was at 27.35. Okay. So let's say I'm just sitting in a long stock of KHC at 27.35. And of course, today KHC closed at, it's not as much as it used to be. This stock had gone all the way up to 36 and then the pullback. So we're at 29.74. Not bad, but some gains. 10%-ish. It's pretty good. A little bit under 10%. In any case, here I am with this position with roughly a 10% gain. The first step I'd look at is go into the insurance tool under married put. And I'll just put in my stock. And I'm going to put in my price. I think it was 27.35. And let me just go, you had mentioned a few months. So let's go out to December or January. I kind of like January, so I'll just go to January right now. So it's an 8.7% unrealized gain. Now, those stocks at 29.74, I see I can lock in 3% of that unrealized gain by purchasing the January 32.5 put, which is what I'm in right now. After rolling down the put as part of the decline, I should have waited and rolled down to the 30 maybe, but when it was at $30.80, I rolled from the 37.5 down to 32.5 and took about $4.50 lower the cost basis on the position. Excuse me. So why would I consider doing this first? Because we're in a position where it's been pulling back. I want to try to lock in some of the gains here before I lose too much more of it. And if the stock recovers, that still leaves me with the unlimited upside axis. Okay? Now, is a collar a good idea if you only think it's going to be for another 30 days or 20 days or so, Octavio? Sure, but now's the question. Remember, naturally, I know everyone knows this, we always like to review it. When we're selling premium for income, we want to sell shorter term if possible. That gives us the higher annualized return, okay? We all know that. The option that's 6 months out in time is not 6 times the cost of the current 1 month out option. And the option that is 1 week out in time is more than a quarter of the monthly. You get a better annualized return if you sell more frequently. On that same note, you get a better average cost per day by buying further out of time. Instead of buying a put week by week by week or month by month by month, you get a lower annualized cost by buying further out. Okay. Now, the one reason I'm bringing this up for our question here, Octavio, is because if I'm uncertain about the market, I've got a position that has an unrealized gains. I want to maximize the premium that I take in on it while still maximizing the protection. What you may consider doing is buying the put, as we mentioned, 3 or 4 months out in time. But rather than sell that call that's 3 or 4 months out in time, where a lot of things are going to happen in the next 3 to 4 months. We've got an election coming up. We've got the next earnings cycles coming up in October. We're kind of in it now. And who knows, question mark, which country, vaccine, who first, doesn't matter, but everyone's making progress towards that. And things are starting to open back up. So I expect continued volatility, especially leading up to and then just after the November election here in the United States. So maybe I don't want to cap my gain to something that's 3 or 4 months out in time where I'm not going to see that time decay work in my favor until I get within the last 1 month or 2 weeks. Maybe what we want to do is maybe more of a calendar collar in a sense, Octavio, where I am going to consider buying the January or December put, whatever meets your needs and your desire for locked in profit. And I'm going to sell maybe something closer in that's still able to give me a reasonable premium, but not too close to the current stock price because I don't want to get caught with a sudden gap and then have to buy this back. Gaps will happen. But remember, if you're selling a call that's 3 months out in time, the time value decay isn't going to work on your favor if that gap happens in the next 2 weeks or 3 weeks beyond your expectations. So there's not much premium here 14 days out. This is craft, so I'm probably going to have to go 28 days out. Still not bad. It's actually terrible. But anyway, let's just go ahead and sell that because remember, I'm already bulletproof here. So this is just icing on the cake. All right, so we just get another 20, 25 cents for it, and we still get a good graph with a shorter term call that we can manage. Although we didn't take as much premium up front, Octavio, for selling the 3-month out and doing a standard collar with maybe the 3 or 4 month out put, we're doing it in this fashion to get shorter term income, maximize the annualized income, hopefully, that comes in. Now, yes, if the gap happens within the next 2 weeks, craft goes back up to 34, well, it's going to cost me $2 or so to buy back this call, and I only got 20 cents. That's a downfall of doing it shorter term. I'm not getting as much premium that I would want to, but it's to be able to manage that short premium and that cap on my position more easily because I'm not expecting large movements over the next 5, 10, 15, 20 days. Craft isn't the best example to do this with. Perhaps maybe a Facebook or an Apple would have been a better look, but you see where we're saying this. Of course, there's nothing wrong if it matches your goals and it matches your needs to, of course, go all the way out to January and do the standard collar that you mentioned. Just make sure that the call that you're selling is always above the put that you're buying. I'm sticking with the put that I bought that gave me that 3% locked-in profit on this position. The out-of-the-money ones did not give me a locked-in profit, even though they were cheaper price. So I'm sticking with the 32.5, which means I'm going to sell that January 35 call. Give me a little bit more upside. And it would help if I correctly selected that I'm selling that call. Fantastic. There you go. So 13% return guaranteed. Let's just call it 5% bulletproof status. Decent trade, 13% return. But now remember, that is for 119 days. Does that match your trading plan? Keeping in mind that you're not going to be able to roll this position very easily. The time value, okay, it's only 48 cents, but you're not going to see time value decay in this position as quickly because you're so far out in time. All right. So those are some of my basic thoughts on that, Octavio. Standard collar is a good way to protect gains that you have in the stock. I'm not sure if you want to go out this far with it, if it's going to match your return. And remember the rules of the ATM bell curve. You really don't start to see that time decay work in your favor for the sold option until you get that last 45, 30 days or so on the position. So I want to be buying out here to minimize the time decay. I don't want to be selling here to take the most advantage of the time decay in my favor. And Octavio says, so we sell 30 days to expiration calls till January. If I was in that structure, yes, I would. And, you know, so I looked at the 32.5 for that October cycle, and it was only 21 cents. As I mentioned, this might not be the best example, Octavio, but that's okay. 28 days, October 16th, 32.50, only 20 cents. But hey, it's just a little icing on the cake because this position's bulletproof. All right, so there I am at 20 cents. Now, if Kraft doesn't go back up to 32.5 by October expiration, this call expires worthless and Kraft's still around 31, then I'm going to sell the November 32.5 and get maybe another 20 or 25 cents. Now, where am I, Octavio? I'm at 45 cents of income, which is equal almost to right where that January 35 call is selling after 2 cycles. Okay, and I still have 2 more cycles to go. I could collect another 40 cents, 20 cents, 25 cents in December if things work out, another 20 to 25 cents in January. So I'm actually making closer to 80, 90 cents in premium as opposed to taking 44 or 50 right now. And if the stock does starts moving up more gradually, not a spike, and it starts to move back up, let's say it goes to 31, then it goes to 32, we go up to 33. Hey, I'm a little bit in the money on my October call, no problem. I can roll this. It might cost me 50 or 60 cents, maybe 70. I can buy to close this and roll to November, or maybe roll further out into October to try to get a credit and maybe the 34, 35 strike. Okay, and down below, in this case, I'm sorry, I was going to look for something here. I think I got distracted by a question that came in, so I lost my train of thought there for a moment. So I would get more of the premium here, selling week by week by week. But if I go to January and I'm holding the January put and I sold the 32 and a half, let's say, in this case, Octavio, and the stock moved up to 34, 35 in that situation, I can only roll up. I can't roll out unless I move the put out because I don't want to have the call further out than my put expiration. Okay, so that's what I'll look to do to try to maximize the yield short term. Go every 2 weeks or every month, depending on what premium is available on the underlying stock. As I mentioned, this is a bad example for the premium, but that's what I might consider. Either or is a good approach, but if you're going to do that standard collar, meaning the same expiration for the call and the put, make sure the call is above your put strike price. Oh, whoops. Sorry about that. Okay, there it is. Make sure the call is above your put strike price. Analyze the maximum return, and then decide for that time frame, 119 days, 120 days, 4 months at a time, or 90 days, does that potential max return meet your trading plan for what you're attempting to do? Okay. All right. Okay. Okay, Octavia says, I like that days expiration short better. Thank you so much. Yeah, I feel, and Sam, I think, comment on this last week, and Ernie would always say this too. It just seems easier to manage those shorter ones because the longer term, you're just waiting and waiting for the time decay to go in your favor, and you're not really seeing it to the end there. Before we get into a great strategy discussion here for Lloyd, Lloyd's next with the back testing tool, then Irene with the great question on management. I'm going to take Fernando's question very quickly. Fernando just asked, is there a way on PowerOptions to see the theta value for the entire structure? It could be useful to understand if the structure is theta positive or theta negative. In the portfolio tools, Fernando, you've got the different views. You could just create a portfolio and track one position, for example. But if you go into the Greeks view, you've got the sums of the deltas, gammas, thetas, vegas, rhos, volatility, so on, beta weighted delta, and position delta as well in that case. So if you just want to look one position at a time, you could just create a spare one, but you can kind of gauge. See here, the Mary puts, of course, are theta negative because I've got a put option that's 3-4 months out in time, maybe a little bit more, and the stock doesn't have a theta. And here, you're not seeing a theta on this collar spread for AEM, February put, but I sold the September 90 call, which expired. This stock did not do as well as I expected, so I'm glad I really sold that call right away. I mean, we got in at 83.79. It went up to 88 and then dropped back down to 80. So I'm really happy that I did sell that call to get that premium for it to climb. But, the put's up over 4 points from where I bought into it. So that's doing what it should be doing for the position as well. But that's it. Just go into Greeks view, Fernando, and you're all set. You'll be able to view the sums of those as well.